Are more gains ahead for shares of DIS?
So I obviously think so. I own the stock. I could see a scenario where over the next couple of years it works its way up toward $200 a share. Disney had an incredible year. They had 80% of box office, which is completely unheard of in the history of Hollywood. And they probably don't repeat that. And of course, that's in the past. But you say to yourself, what will change with the competitive dynamics of the media industry over the next 6 to 12 months to knock Disney out of that top position in all of the various categories they're competing in? And for me, it's really hard to figure that out. I'm not quite sure what's going to change. The popularity of their films has never been greater. The launch was a smash hit, no asterisk, just a complete smash hit on over-the-top streaming. And there's no content there. It's all old content. They have like 2 or 3 new shows. So to me, they're only going to get better there. And then you think about some of the things that have been ailing them in the past, like cord cutting and ESPN. And I feel like they've done one of two things. They've either gotten those problems under control or they've ratcheted down the expectations for those specific problem areas to the point where Wall Street is not downgrading the stock over them. So, look, it's not cheap. It's 23 times last 12 months earnings. It's only a 1.25% yield. It's not like a classic value stock. For me, this is a company that's found its footing as a growth stock again. And I want to be long. I want to be involved. And I think it goes up.
Okay. Now, Stephanie Link, you own it. You have been trimming it. What do you make of what Josh said, the view on the stock? Part of this note says plenty of funds are long Disney, but few are, quote, really long, and thus they're going to look to build positions on weakness.
Yeah, so I was overweight the stock for much of last year. Now I'm market weight relative to my benchmark. So I'm really not making a bet either way. I'm inclined to trim further because it has had a nice run. It is up 32%. It does trade at 26 times forward. 72% of the sell side has buys on it. So it is a consensus long idea. Whether portfolio managers, sure, but whether portfolio managers are really long or whatever it is, okay. But I just think that the easy money has been made because it's a fabulous company. They have a very diverse earnings stream. Josh highlighted all of them, right? So I think that that's very much the case. What are you willing to pay for that? And so, to me, the competitive landscape kind of keeps me on the sidelines with a bias towards
my only comment on that, and I don't disagree with what you're doing. You don't want to be materially overweight relative to your benchmark. For most of the viewers at home, they're not constrained by benchmarks. And the question is, do they want to be in Disney or not? They don't have the same, I understand that, but math that you have to go through.
Sure.
Totally agree.
But I'm also inclined to sell more and to go underweight.
So now,
right? Because it's had a nice run, and I think it's smart and prudent to take profits. This stock was a fabulous performer last year.
So, but let's pull the
only gets more intense going forward.
Let's pull the lens back, though. Let's look at Disney on a monthly chart. Let's look at the last 10 years. Actually, the stock doesn't really tend to trend in one direction or another. It moves in bursts. And I don't know when the next burst will be, but, it's had a consolidation period that started in 2015. It hit 120, and then it spent the next 4.5 years below 120. It just broke out last summer.
Of Disney Plus, right?
No, I fully agree.
It had a re-rating. How much more of a re-rating does it get from here if they have to continue to spend and invest on this part of the business?
My point is, the bigger
you don't get the earnings growth. So what are you willing to pay for that?
The bigger the base, though, the bigger the space, and I think it's just breaking out now.
Everybody owns the stock on the desk, so it's a good discussion/debate to have. Good points made on either side of you.
Well, and I think Wells Fargo probably listened to Farr's top 10 picks, one of which Disney was certainly one last time I was on the show, and they're a little late to the party, but good for you, Wells Fargo, for catching up. I'm kidding, Wells Fargo. I love you guys. Look, I look at this a little bit differently. I want to own this stock for the next 5 years or 10 years. And yes, it had a great year. I owned it last year. It had a great year. But, their online service is going direct to the consumer. They're going into Eastern Europe early in this year. They're going to go into South America and open up those markets. This is a growth story with a fabulous balance sheet. I think that This is where you want to be long term. You're going to have these gyrations.
Not too expensive, though? 27 times
No,
forward?
I don't think so. Not for what's ahead of it. I think the fundamentals are improving, and it's got real growth in a world where growth is really hard to find. I mean, when we started last year, we saw the S&P growth estimates almost 10% across the board. They were lowered every month throughout the year. Disney held in firm. I think Disney is as solid an earnings growth play for the long term. Good balance sheet. I'm there.